Those very words. I'm getting a signal from my colleague to say that she can see us where she is. So let's get started. Well, thank you all very much indeed for joining us, whether it is today at the beginning of June or in the weeks and months ahead via the recorded podcast. As ever, when we do these things, we have attendees from a very wide variety of different places, and you are all very welcome indeed. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. One of our publications is Sustainable Investment Intelligence, which focuses heavily on both climate and nature risk. And what we are talking about today is something that we have been examining in quite some detail recently. And we are very pleased indeed to be hosting this webcast with Climate X, who are one of the leading specialists in this area. Sustainability risk is becoming much more integral to the investing process, and the reporting of it is obviously absolutely critical to that. As we have investigated this exceptionally complex topic, we've come to realize that not enough attention has been paid to it by the industry to date. And as a result, we believe it has been causing unnecessary problems both for LPs and for GPs. And that is a large part of the reason why we wanted to host this particular podcast today. So I'm now going to introduce the panel we have for the discussion. We have Chris Addy, who is the CEO of Castlehall Intelligence. Chris is based in Montreal. Castlehall works with, I think it's over 200 asset owners, Chris, around the world. And he's here to represent, if I can put it this way, the asset owner, the LP perspective on this particular topic. We have Alex Guebeau, who is Director of Sales North America at Climate X. And we have my colleague, Samantha Taylor, who's head of research at IFI Global. And she's the person within IFI Global who's been doing most of the real research work for us in this particular area. So we're going to split this in actually into 5 different categories today, the 4 on the screen that you see, but also we're going to allow approximately 15 minutes at the end for questions too. Please use the Q&A button at the bottom of the screen if you'd like to make a point or ask a question, and hopefully we will come to it before we conclude at the end of the hour. So without further ado, let's get on to it. I'm going to ask each of the panel members to do a brief introduction of who they are, and then we'll get into the first section of the questions. So, Chris, would you mind giving us a quick resume of your role as CEO of Castlehall Diligence?
Sure. So again, thanks very much, Simon, for the invitation. And Castlehall was founded in 2006, so we now have 20 years of history supporting asset owners, investors, limited partners, conducting due diligence on their third-party asset managers with a focus on alternative investments. So that is both hedge funds and particularly private markets across its various flavors, be that mainstream private equity, venture, private credit, infrastructure, and real estate. And the core of our business, I am an accountant and a CPA for my sins, as well as a CFA. The core of our business has been operational due diligence. So I always like to say I'm out of business at the point that the asset management industry becomes entirely honest. So I'm feeling I've probably got a little bit of remaining runway in my career. But we have been focused on other areas of diligence and risk management, including what at the time was named ESG diligence, which we started 10 years ago now in 2016. And from that point, we felt there was a lot of overlap in terms of looking at operational due diligence as well as looking at the due diligence around ESG implementation, ultimately providing the context of a perspective on an asset manager of does the manager actually do what they say with respect to the integration of environmental, social governance characteristics. And of course, now we're much more focused on a frame of climate sustainability impact. Are they actually doing what they are saying? So in essence, looking for what back in the day again was called greenwashing. Looking forward, we continue to support a subset of asset owners as they look at the climate, environmental, and other aspects of their asset manager relationships. Particularly, our business in this area is notably strong in Australia. Equally, of course, it's an interesting times as we have clients in North America who are probably as interested in green hushing as they are with greenwashing. So clearly, we're in a different paradigm, and it's going to be really interesting to spend the rest of the hour unpacking some of that with Alex and Samantha.
Thank you. And Alex, over to you.
Yeah, my name's Alex. I'm the commercial director here at ClimateX. We were founded back in 2020, so not as long as Castle Hall, but we've really carved a nice niche in the industry and built a name for ourselves. So started off in the UK at the right time where regulations were really coming about from a climate risk standpoint, helping a lot of the banks deliver on those regulations. And then due to the defensibility and obviously the depth of the outputs that we were able to provide, started expanding across different industries. So went from banking to obviously asset management, investment management, private equity, insurance, and now we have a global presence and actually based in New York now. So leading the team out here, which has been quite exciting. And I guess to the topic of this, I think it's really pertinent. Having worked with a lot of our peers in the private equity space, on both the LP and GP sides, and trying to embed their climate risk frameworks and drive efficiencies, and also just gain some good insights on this front and how it could impact their returns in the long term. We know that there's definitely some areas for improvement, and we know that there's some pain. So keen to share some insights on that, but also provide some of the best practices some of the industry has been pushing forward. So should be a good conversation.
Thank you very much. And Samantha.
Yes, my name is Samantha Taylor, and I'm the head of research at iFi Global. iFi Global focuses a lot on sustainable investment related matters, including climate risk. As Simon mentioned, we have a publication called Sustainable Investment Intelligence, which includes our climate risk tracker and our new nature risk tracker. These entities monitor and record, both for LPs and GPs, the identification, assessment, and management of climate and nature risk. As a result of doing this, we are developing a good intelligence on the different ways that both LPs and GPs manage climate and nature risk. We have come across some significant variability in some of the approaches taken. And just quickly, SII is in general a very research-based publication, and we are just about to embark on a major study with asset owners on natural capital investment and really go into the sub asset classes within that, which should be really interesting.
Yeah, as you said, this will come out in the course of this conversation. There is quite a lot of variability in the approaches taken to this into this particular area. So the first question in the first section, which is of LP and GP reporting intent, is has sustainability stroke climate reporting shifted from a transparency and risk management tool towards more of a reputational litigation defense type exercise, and what are the consequences for both climate and sustainability management. Before I'm going to come to Alex in a second, but before that, perhaps Samantha, you could just mention, because we see quite a lot of litigation in this area, don't we? And one of the
Yeah.
reasons why probably it has done that is because people don't like ending up at the wrong end of a lawsuit, particularly very often.
Yes, I would really say that litigation as a whole is increasing quite notably, and particularly climate-related litigation. Pension funds are, explicitly they're very visible investors, and you are seeing within their public disclosures, especially disclosures from Australian superannuation funds, that reputational and litigation risk is really front and center within their climate risk management disclosures, which is quite interesting. And obviously, as Simon mentioned, there are a few cases coming to light, the recent one being Cushman and Wakefield, which was obviously brought by a former employee of the 401k plan. It was obviously action launched in breach of fiduciary duty for retention of a chronically underperforming fund, which is the Westwood Small Cap Fund. And it is, I believe they said that it is exposed to inordinate amounts of climate-related financial risks. So yeah, that's one of the latest ones. But obviously, back in October, you had the Canadian Pension Plan Investment Board. I won't go into the details of this, but it was brought by 4 beneficiaries, alleging that the board is understating climate risk. Yeah.
That may be that part of the reason why the reporting has gone the way. Just want to set it up for you, Alex, in terms of what you might want to say. Over to you.
Yeah. If we take a look at on the LP side specifically, it really depends where they're at on their climate risk journey. I think regulations tend to accelerate that, right? And and kind of make climate or sustainability a key priority, because obviously they don't want to be penalized in the long run. But you can really tell if their approach is more so a tick the box exercise versus actually having some sort of intent or leading to some of the investment decisions behind the initiatives of actually embedding climate risk across the organization. What I tend to see is, if LPs truly consider climate and sustainability a priority, irrespective of regulations, and we can take the US, for example, we know that there isn't necessarily some regulations in the US aside from SB 261, which we know has been delayed. We're seeing a lot of our clients still prioritizing it because they see value behind it. And the key differentiator is to determine if it is truly compliance-based or not, is that there's intent behind those reports. And you're seeing some progress year over year, and you're seeing how it's actually influencing some of those investment decisions.
Yeah. Chris, do you have a particular view on, well, first of all, do you agree that the reporting is shifting in the way that we mentioned in the question, and what do you think the reason might be for that? And you mentioned Australia as a market, where you're very, very, very familiar. There's been a lot of litigation down there, and indeed in Canada too.
Yeah, I can speak from both perspectives, despite the British accent, of course, being Canadian. Although I do live in Quebec, so for us it's more CDPQ, Caisse de dépôt placement du Québec, rather than CPPIB. I think it is a very multidimensional topic. And for me, I probably have a slightly different frame, in the sense that we have existing investments and forward-looking investments. And of course, in private markets, if I'm dealing with private equity, private credit, infra real estate, typically I'm going to invest in pooled fund vehicles, which are normally a 10-year life entity with various extension capabilities. So ultimately, as a limited partner is, as the name implies, limited in their responsibility and opportunity to direct the investment strategy. That has to be more of an information gathering exercise, but it isn't something that in many cases is possible for the investor to directly influence the asset manager in terms of their future investment activity. We may be beyond the investment period, these may be assets in harvest, we may be in the investment period, but at the same time, it is the GP that controls. Now, of course, If we're looking at direct investments, making new co-invests, potentially buying things in the secondary market, and of course, underwriting new investments, could be a new GP, could be a new vintage from an existing GP. That's where we having the luxury and the benefit of well-constructed pre-existing climate data, I think becomes very helpful. But we have a lot of cooks in the kitchen, I think, wanting different and varied things. We have clearly, if there is a regulatory requirement, I have to meet that or I go to jail. And of course, regulations are themselves not conformed and consistent across the world. One thing we see is individual efforts from investors to build their own, what was an ESG group is now more of a sustainability impact, climate, environmental group. I personally am somewhat cautious when a group decides to develop their own schema. It's very easy for these things to get a little bit out of hand, and for the individual team who works in that vertical within a large pension organization, for example, they're proud of what they do, they believe in it, but obviously the managers don't appreciate being sent hundreds of different format questions asking for more or less the same sort of stuff, but in quite different formats from a large number of different LPs. And I think that comes to the core title that we have here in the session. How do we get more standardization? And I think the other key word here, and Alex brought this out in some of our pre-planning, was materiality. One of the other things I think investors, especially internal groups who are trying to a degree justify their position and show they're doing well and demonstrate their value to the organization, it is very tempting to develop really long, intricate and granular questionnaires. And that's great, but some of the GPs just won't answer, and the many of them that do won't answer it particularly well, which is before we get to responses now being primarily generated by AI. So I think we have to really take a step back here and say, if we're gathering something, let's make it sure it's material. And material, by its very definition, means that it is of sufficient size and scale that it is materially able to impact a decision. So an investment decision. There is not necessarily as much value in gathering information just for internal purposes, which is where I think, for internal, the sense of having a large database that does not ultimately necessarily impact the investment decision-making process. But to wrap this sort of train of thought, that is where, of course, we come back to the concerns about reputational damage, litigation impact. And obviously, one of the key defenses that I can have is to be able to demonstrate to a litigant that I have gathered loads of information, I have a lot of data available, and that, of course, can overwhelm the plaintiff. I personally think, again, I'm in Canada, I've read the CPPIB complaint. I actually think it's pretty counterproductive. We have a social justice law firm called Eco Justice. Their agenda is pretty evident in the name, what these guys are trying to do. This is not a balanced perspective as to how CPPIB, as an $800 billion pension plan, can pragmatically and realistically deploy its assets. It really is an extreme single position perspective, and there's many valid points, but how at the end of the day do we think more pragmatically and centrally to how do we gather climate information that genuinely can lead to forward-looking enhanced investment decisions?
Thank you. I'm going to go on to the next question, which we'd like to move to, which is one of the most, if not the most critical, well, certainly one of the most critical, which is what are the top 2 to 3 purposes both GPs and LPs actually need climate and sustainability data for, and what decisions should good reporting enable? Alex, can you tackle that?
Yeah, for sure. And I think, Chris, you'd be quite surprised to see, and I agree on the CPPIB front. They've done a lot of work, and it is a key priority. And we also know in Canada, there are some directives and expectations from a sustainability standpoint, but irrespective of that, a lot of these large firms are taking it as a priority. And if you take a look at some of the key use cases on the LP side, I mean, you touched on it, manager selection and due diligence, that comes into play, right? So before any capital is committed, LPs are kind of increasing that due diligence, the screening process, and questioning a lot of the GPs on their climate risk capabilities or sustainability capabilities. And they're not just looking for this tick the box exercise, but seeing exactly how it's embedded, and they kind of rate the profiles across the GPs. I think stepping away from forward-looking investments, but more so looking at their current book of investments, yes, it's true they can necessarily change I guess investment diversification that they currently have on their pot, but it could definitely influence the portfolio construction and allocation for future investments as well. So a lot of these LPs are using this data to take a look at, all right, across my different investments, different asset classes, where's that concentration of risk lie? And perhaps that can influence some of those future decisions as well. And it kind of ties back to that manager selection on the due diligence front. They use it also as an engagement piece. I think the LPs that are really advanced in this process, stepping away from just regulations, they're going to be inquiring to their GPs about some of the climate risk profiles on some of their investments, and then also, I guess, drive that engagement or inquire further as to what is the potential impacts that could come from it. And even like, hey, is there any CapEx that is being allocated to potentially mitigate some of these risks? Or, hey, it seems like, I don't know, if we take real assets, for instance, and a majority of them are located, I don't know, in Florida on the coastal front, we also know that insurability might be an issue in the 10, 15, 20 years. What's the plan to kind of mitigate that, right? So there's some positive signals that can come through that the LP can then use to then inform their future investment decisions.
Okay. And one of the things that Samantha, I say we, I should really say you've been looking at is one of the reasons they need this data is more and more actually not for defensive litigation reasons, also for as you put it, for value creation. Is that right?
Yes, definitely through our research with private market GPs, you are seeing more of them kind of create use cases with climate risk analysis. So it's not just used at pre-acquisition screening and not just at exit, but it's, take for example, renewable energy strategy. Our research shows that managers such as Gore Street Capital and Resonance Asset Management continually use climate data throughout the whole period, specifically for performance optimization of the asset itself, which is really interesting and differs materially from traditional infrastructure assets. Obviously, within traditional infrastructure, transition risk is really the focus, and that is used across the board, really, in a kind of a general way to maximize valuation and to inform value creation strategies, because obviously transition impacts your buyer's appetite, capital durability, potential things that you can add on to improve your assets' value.
It's a really good point, actually, on that front. On the value creation piece, I'm sorry to interject. When you take a look at climate risk and sustainability, not to say like it's fully nascent, but it relatively is, right? And only now that we're seeing LPs and GPs kind of approaching it and embedding it, we're starting to see now some of the positives that come out of it. And what is it called? The EDCI, which is a data convergence initiative ran across GPs and LPs. So it's a group of them kind of put together, and they've done an analysis internally as well. And we're seeing some of these results now. And one of them that really stood out to me is that when you take a look at partners that are leveraging sustainability data, it directly correlates with EBITDA growth. And I know that this is a touchy subject and we can unpack this as much as we want, but they've seen that EBITDA growth across portfolio companies. And basically the conclusion on this front is that when reporting is built really around decision useful data, it becomes an investment signal, not just a compliance output. So some good examples that we're seeing with some of the GPs that we're working with is, they'll take a look into one of their portfolio companies that might have a pretty complex supply chain. Maybe they've underestimated some of the risk linked to that supply chain, impacting the delivery of certain goods if a certain flooding event is to occur. and driving those mitigation plans into place, or at least improving your, I don't know, discovery recovery plans directly correlates to some of that growth. So it's, I think more and more now, and as time comes, we're going to start seeing a bit more of those reporting and some of the positive signals that come out of it.
Yeah, it's going to vary by strategy, of course, significantly, but
absolutely.
That's a very well made point. In certain areas, absolutely, yeah.
I think I'd actually add to that one other perspective. When we're looking at the fundraising environment, clearly fundraising is below the peak of the market for private capital strategies. And I think there are various statistics that suggest that the vast majority, 80 to 90% of capital, go to the 10% of managers that are the largest. Many large pension funds do have core relationships with the usual suspects of the Blackstones, the Brookfields, the Apollos, the KKRs. It seems to me that for a general partner, for a GP, an asset manager spending more time to enhance the quality both of embedding climate into its own investment decision-making process in a way that's demonstrable, tangible, and real, and then equally providing enhanced reporting back to investors. That's a very helpful way of adding something to the differentiation sheet that will help a large or medium-sized allocator be looking away from their existing roster of GPs and be ready to, quote, risk an allocation to build a relationship with a new asset manager that sits outside their sort of traditional top 10%. So there's also some very helpful points of differentiation, actually, when the rubber meets the road of the well-intentioned, capable asset manager, that firm needs to raise capital for the next fund. So it would seem to me that some of the climate reporting elements can really be packaged there into very good signals as to the intent and purpose of the investment strategy, and to be in a top quartile position in terms of communicating tangibly and visibly to investors over the lifetime of the fund.
I'm going to jump in here, if you don't mind, ladies and gentlemen, because we're already halfway through in terms of time, and we got a lot of stuff to get through. So we're going to crack on to what we've called section 2, which is the quote unquote language gap between LPs and GPs, and where inconsistencies are coming from. Alex, can I ask you, which information requests are from the LPs are truly decision useful, and are versus which ones are driven by regulation scrutiny? But as we were discussing earlier, the ones that are driven by regulation, as Chris said, you can end in jail probably if you don't get that right too. But nonetheless, how can you break this up?
Yeah. Like I said earlier, I think if there's intent behind it, and if it's built for decision use first, and Simon, you mentioned it varies a bit also across different asset classes. I think when you take a look at real assets, I mentioned CapEx allocation to build climate resilience. On the equities front, especially on the active side, what is that supply chain risk concentration across risk? And it's interesting to see as well, like when you take a look at other asset classes or where they are on their journey, especially on the GP front, the key one that you'll look at is real assets to start off, and then you'll move over to some of the equities. And we're starting to see some of these use cases across private debt and bonds, but it's a bit more, not to say obscure, but there's still some work in defining that. So a lot of the value right now that our clients are seeing is definitely across real assets and private equity, but where to make it really decision useful, you'll see it first and foremost in just how the question's asked. I mean, is it leading to a specific decision? Is it going to influence where, the decision of the investment? And I think one of the key takeaways as well is you'll just know by the engagement. Like if you're a GP and you're working with an LP and you're getting a ton of questions coming your way, but there's silence afterwards, you can kind of hint that that's probably more of a compliance-driven request more so than it is a decision useful one, right? And to Chris's point, if you're a GP and you have 12 different LPs reaching out to you with 12 different metrics that are all mapping on the same underlying kind of exposures, it just creates a lot of friction. So to make a decision useful, you also got to drive a bit of that standardization, and that needs to come from the LPs to just make the GPs' lives a bit easier.
Do you want to add anything to that, Chris, or I guess the point that I'm getting out of it, it's kind of the LP's fault, to be blunt about it, because there's no consistency. Could you, on behalf of your clients, get them to be more consistent in what they want from climate risk data or sustainable data?
I think it's very mixed, and we really have a full spectrum here. But I think the sweet spot again is being respectful of the relationship with between investor and asset manager, and really focusing in on what is material. And there's just so many different perspectives. Some very large investors just really like to say, look, I'm $500 billion plus. They have to answer whatever I ask them. And when you actually get into it, yes, I've got answers back, but they're inconsistent, of poor quality. We also have the practical issue. We certainly see it very much in operational due diligence. The internal ODD purpose is very, very proud of his or her spreadsheet and his or her question list. That really is career defining their proprietary IP. And that certainly segues over, I think, also into what was ESG, now more climate, and equally DEI type surveys. It's very easy to think that something's better because you've asked more and more questions. Whereas really, just as I said a few moments ago, 90% of the capital is going to 10% of the asset managers. Well, probably 90% of the information can be gathered within a core corpus of 10% of the key questions. And I think there's a lot of there have been attempts at standardization, and quite often things go in a very predictable format. We start with something fairly straightforward. It gets expanded, goes over a tipping point where there is pushback as to the administrative burden and just really the complexity of trying to figure out a convoluted matrix of questions. We've seen that, I think, more recently with the PRI, for example, that has cut back on its reporting. I think that's where we'll likely find ourselves with something that is a little bit more standardized and central, and ultimately that's what makes sense. Again, if I'm a large investment asset owner, I probably have 500 asset manager relationships. I could have easily more than 1,000 underlying funds. If I'm gathering some core metrics on all of those 1,000, then that's a very helpful standardized data set. Where I can really dig in is when I'm making new investments, or where there is that opportunity for engagement with respect to specific assets, a subset of managers, co-invests, directs, things of that nature. But I'd really encourage LPs to think about what they're asking, and yes, you're not automatically 5 times better if you're asking 500 questions rather than 100, and unfortunately that is bureaucratic human nature to a reasonable degree.
Yeah, so you're saying, if I've understood you correctly, Chris, that it's to do with the nature of the LP, the size, the amount of investments that LP is making in God knows how many funds, and that's kind of one of the reasons why it's difficult to get a more standardized methodology, and some are like their way of doing it but more than others, etc., etc. Samantha, can I ask you, isn't it also, or would you say it's also depends largely upon what underlying assets they're investing in, because they're not all investing in the same assets, are they?
No. What we have noticed is that climate risk management, and just how climate risk data is integrated into the investment process or the risk management process, does vary materially by asset class. Private credit will use it differently to private equity. Private equity use it different to infrastructure. You are seeing differences with real estate. And I believe it is Patrizio Asset Management. They're really working on creating a standardized way of managing climate related risk within real estate itself, because even within that asset class, there is no consistent way to which climate risk is managed currently.
Yeah. Right. Unless anyone wants to add to that, I think we should keep cracking on and move to what potentially could be the resolution of some of these problems. We've, I guess, been touching upon that to a certain extent in some of the answers that you guys were just giving. But let me come to you, Alex, and ask, what should be standardized? What could, there isn't already, which is virtually nothing, what could be standardized? And in our prep, we came up with some examples. Definitions, could they be standardized? Minimum data sets, assurance versus left to flexible for strategy and asset level nuance. What can be standardized, do you think?
Yeah, I mean, there's the point of architecture as a whole. So for LPs to make it a bit easier on GPs, I agree. I think instead of sending out questionnaires of 100, 150 questions, start with, I don't know, 10, 20, some that will actually lead to some of the key decisions that can drive change within the LP strategy. And find a standardized way to share that across the GPs to make it as easy as possible. I think that the biggest gap and a lot of where we're putting our time and effort is, for us, Climate X, working in between the LPs and the GPs, right? We know that one of the challenges is if all the GPs are using different sustainability or climate risk data providers, that means the methodologies will vary. That means the outputs will vary, the definitions behind it. Meaning that it makes it a lot more challenging for the LPs to decipher the outputs and I guess build defensibility behind those points. So where we kind of come in will be to help the LP standardize that process and then work with the GPs to ensure that everybody's working off of that same data set. So I think that's definitely one of the key areas where we can drive some efficiencies on that front.
Should there be, I'm just thinking out loud here, should there be some sort of, maybe Chris, there is something already, or some sort of LP type entity there where these thoughts should be shared on a sort of neutral basis for people to get together and discuss these things? Does this happen at all, or could this happen? Or should it be left to Climate X to take the lead?
Well, Climate X seems very well positioned. So, I mean, there are obviously various venues and forums. ILPA, the Institutional Limited Partners Association, will be an obvious one. Equally, I mentioned a few minutes ago the PRI, Principle for Responsible Investing. So there's been various different forums and venues, but this is a very broad industry. And I was just sort of listening to Alex in his last remarks, talking about different use cases. Samantha, your comments about different asset classes. And, if we really think about it, there's almost sort of three categories of GP and or strategy. So clearly we have a subset of strategies, GPs, who are focused on delivering climate first strategies, be that energy transition, be it impact, be it an area of a strategy and a portfolio and a fund that is designed with climate first outcomes in mind.
Yeah, that's a good point.
And of course, an asset owner may say, well, I've got a very diverse investment portfolio here. One of the ways that I'm going to attack climate is allocating a particular segment of my portfolio dedicated to climate first outcome funds. And then I've got everybody else. And of course, some of those are going to be integrating climate forcefully, and there are going to be plenty who don't care. They just want to make a bonus, and that's as we know. And I think one of the challenges that ILPA finds is just really that ongoing tension between what do investors want, what are the general partners prepared to give, and this is a very, very legalistic industry where the lawyers come in at $2,000 an hour and really mire everything in intensely complex legal agreements. And one of the issues that LPs have is, even if you're at the negotiating stage to go into an asset manager, you may find a lot of pushback if we have an aggressive law firm on the other side. Of course, you're paying for, because it's going through as an expense to the fund, who are really resisting those your climate reporting, climate engagement objectives. I think we really forget just how adversarial this can be, particularly thanks to that legal element. So at the same time, I think one of the other points I wanted to raise was just this question of lack of standardization. So let's say I'm a large pension plan and I've decided to allocate $5 billion to data centers. I could be getting some quite different climate reporting around those data centers, be it energy usage, water usage, other impact areas, from what looks to be a similar data center. And when it gets super interesting is when you have one mega data center that's actually owned in part by different asset managers. You happen to be invested in two or more of them, and you've got different numbers from the different asset managers for the same asset. So there's just a lot of unpacking and an attempt needed there to try and normalize, or at least make reasonably consistent, the undergoing data. Otherwise, we have work for the next decade for a team of 20 just sorting out the false positives.
Yeah. Alex, would you like to add to that, can we go on to the next topic here, which is how do we avoid reporting becoming a tick the box compliance exercise instead of making it a driver of risk management and engagement? That's actually probably, if we could make it something more of a driver of real risk management and engagement, that probably really would be an advance.
Yeah, and it'll be a good segue to Chris's point as well. It could look like a massive endeavor from an LP standpoint when you're, trying to embed climate risk across the entire organization, the different teams, the different asset classes. The ones where I've seen doing it successfully comes down to governance. That's really what separates the laggards from the leaders on this front. And it's less so about the framework that you're using, but more so like who signs off on those numbers, right? So if you take a look at the different layers at the top, it would mean that you have the CIO, the investment committees that are treating climate risk as a key input to portfolio construction. In the middle, you'll have the portfolio managers, portfolio management teams that are using climate data when it comes time to evaluating the GPs that they want to work with. And at the operational level, it also means that I guess LPs are reporting and the stewardship have really clear mandates. And to add an extra one, which Chris is a good reminder, there needs to be some incentives behind it as well to drive that change, right? So I think on the LP front, that's where really we've seen a lot of success happening. And then, for GPs, the ones that are really successful in this space have a unified reporting that not only complies with driving decisions and driving intent, but it covers the LP reporting requirements, but also the regulatory ones. And there's a way to do it at the same time. You can build a framework that ticks the boxes, not to say tick the boxes, but delivers on both, right? And when you can find that nice sweet spot, you're not adding more work. It doesn't come off as more cumbersome. And then it really just comes a really good engagement point that both the LPs and the GPs can have a conversation around, so everybody wins.
Okay, Samantha, am I right? I think I am in saying that this is something you've done some particular work on, in that the whole point about it becoming more of a sort of value creation rather than a tick the box function. Is there anything you would like to chip in here?
Yeah, I think obviously I've given you the example of renewable energy and infrastructure, finding more use cases for climate risk data and creating kind of value strategies alongside that. But I would say quite a notable difference, I would say, is GPs that have fully integrated climate risk within their traditional risk management frameworks, because obviously climate risk is a multidimensional risk. It has impacts on traditional risks. It can heighten them. And I think for longevity and resilience of the strategy itself, you can't avoid treating it as a standalone risk. And I think going forward with the whole climate risk management and climate data being used for value creation, especially within infrastructure and maybe even real estate, I think managers that do fully integrate it across the life cycle and within their frameworks are really going to benefit from it.
Yeah, we need a whole separate session on integration of this into the traditional risk management. We have another publication which does focus upon called the NEB, which is started as a fund governance, which still is a fund governance publication. But the integration of risk in some of these areas, sustainability in climate, is a big issue. Which I'm going to shut up on that point because I just use up the rest of the time just on that. But it is the integration is the challenge to a certain extent, and finding people who know how to do it is an even bigger challenge, I think. Right.
Yeah, I also think, sorry, just
on.
quickly before we move on, I think also transparency as the methodologies and the metrics used is something that can really be improved on and will have material benefits.
Yeah, that's very true. Transparency or the lack of it is very, very, very important. Okay, I'm very conscious of the time. We've got just under 15 minutes left. We haven't done AI. Can we do AI? And then I see we do have some questions, including one or two quite long ones and quite a challenging one aimed at you, Chris, I think. But do you want to say anything, Alex or Chris, on AI before we go to audience questions?
Yeah, I mean, on the AI front, I mean, I think everyone's kind of seeing the efficiencies that could come from it when it comes to analyzing data, drawing some conclusions. I think for us on the climate risk front, it means that as climate models are becoming more sophisticated, it allows us to accelerate our innovation. So, we talk about these different asset classes. The first one that comes to mind is commercial real estate, or that seems like a simpler one for us to assess. But the moment you get into some of these really complex infrastructure projects, with linear assets or pipelines, or you're taking a look at bonds, something that's analyzing some significant data sets, AI can help us build solutions and really tailor those outputs to the different GPs. So that's where a lot of our efforts have been. And obviously the end goal is to get into a place where we can tailor these outputs and cover every asset class.
Chris, I know you just said we were waiting to start this, you're actually at Castle Hall starting podcasts on AI. So I don't know whether maybe you can refer the audience to those. Maybe one day you'll be doing one on climate risk analysis and AI.
Indeed. I think I probably have two sides to this. And again, coming back to the one issue on questionnaires, virtually all large asset managers have implemented or are in process of implementing essentially an AI-powered DDQ responder, whether that is investment risk questions, whether that is my world of operational risk questions when I'm asking you about how you move money and value the assets and deal with your compliance, whether it's climate, whether it's more traditional risk management measures. And I think I think is going to really reduce the edge and granularity of individual questions. You're no longer going to get managers answering what you've asked. You're going to get the AI looking at your question and providing the response from the compliance approved library of questions that is closest. So we're really seeing a drop off in the specificity and true granular targeting of answers. And that veers from things that are still quite helpful through, to be honest, just complete AI slop. Where we're also getting is the investors themselves are also enthusiastically running AI. So somebody's, they've hired a head of AI who got all excited and has spooled up some AI agents. to handle all the boring outreach to the GPs. And this is where it's really interesting. The GPs tell you they hate responding to questions from all these LPs. The LPs say that they hate having to herd the cats of all of their GPs. It is such a inefficient world. But I think we're going to get to an A to A world, an agent to agent world, where the investor's agent starts to ask questions to the asset manager's agent, and we sort of have an AI negotiation / fist fight as to what information can be provided to investors. So I think, again, that's a real trend we're seeing on the DDQ side. The other thing I would also say, though, is as in the larger organizations, once you're sort of at $50 billion and above, everybody is working towards at differing speeds, but working towards a whole of organization data strategy. They are all looking to have a centralized data warehouse, whether it be something like Snowflake or other similar type tools, where they're looking to ingest petabytes of information. They want absolutely any data they can get on anything. And the goal is to have a central surface, a knowledge graph that they can then exploit, whether that's questions around investment performance, attribution, risk management, climate, operational due diligence, tax, legal, sanctions, geopolitical risks. There was a really interesting article, I think it was in Private Equity International yesterday or Monday, talking about GIF in Saudi, which second largest after the Norwegians. They were saying how they are really looking to build centralized data lakes around all of their supply chain exposures for obvious reasons. And that, again, was just really interesting to see how AI is, the starting point of AI, of course, is data. And I think these large organizations literally want to ingest petabytes of information to see how that then can be fed as raw material into proprietary AI tools to uncover new insights. And that GPs need to be ready for left of field questions that they wouldn't have thought of, that perhaps the investor's AI has generated. Those could be great questions, or they could also be AI slop.
Right, and we've only got literally 8 minutes left. I'm going to try and pick out 2 or 3 questions, and maybe you can answer them in quick sound bites, and if necessary, we can follow up with, if we've got the name of the person, and we do have in a few cases the person has asked the question, in others we don't. I'm going to go to the long one. I'll read out the long one from Ellen Lederman. Said, Chris mentioned regarding range of DD questions from investor groups in funds that may not be material and not standardized. Anyone using some of the standards that have tried to be developed historically, whether say from say GIN, UN, SDGs, MSCI, blah blah blah, you know, but also in terms of data produced by the funds. That's more of a comment than a question. Somebody asking about whether there's a recording. Yes, there is, and we'd be delighted to tell you about that. It'll be up in a couple of days. Would you agree? Yeah. This is a more general question, that sustainable risk data business is in its infancy, and how will it develop? Will it become more? Will climate and nature risk become more integrated? Chris, do you want to deal with the long question where you're named as the recipient of that, and then Alex on how do you think the business will develop?
I mean, I think really, as I've discussed in this, there's just I think it really depends on the organization who they hire and whether he or she has a preferred framework, what's happened in the organization in the past. But again, I think it's changing, and I'd pass the baton to Alex to talk about how different forms of data can come through in a more standardized form.
Yeah, I think when you take a look at a lot of the frameworks from a regulatory standpoint, they all really follow, a similar framework. It started off with TCFD, which then fell into ISSB S2. The SEC and SB 261 is kind of built off of TCFD as well. And the asks are pretty similar. And the framework is a good starting point. But then for organizations that are looking to take this on, it's a good starting point. But then to evolve to the next stage, you really need to start thinking about some of these questions, how are they going to influence some of the decisioning internally? And, to Samantha's point, it varies from one asset class to another, and those need to be accounted for.
Okay. Unless anyone, I actually thought you. Thank you for being so literal with your responses to my questions. I wasn't expecting you to be so quick. And quickly see whether you can in 1 minute answer anything else.
For sure.
And then we will wrap it up. Yeah, I mean, there's one question which is actually a bit repetitive, what to a certain extent we've already been talking about, which is how the whole climate sustainable risk reporting has changed and what changes there will be in the process of it in the next couple of years. And maybe that's for you, Alex, as well.
Yeah. So I mean, look, the standards on the regulatory front, yeah, they're continuously evolving. But I like that last question around, is this still in its infancy? How is it going to develop? Yes, still in its infancy. How is it going to develop? I mean, just with climate models alone, they're improving, every year. When regulations first came about around 2020, we were dealing with, the climate models from the IPCC, which was like the 5th edition. Right now we're in the 6th, and we know the 7th is coming in the next year or so. And what you're seeing in the evolution of these models is just additional inputs. So to Chris's point about how a lot of firms are trying to gather as much data as possible to accelerate some of the decisioning, we're seeing that as well in the climate modeling alone. And obviously, just the pace that technology is evolving at allows us to ingest more data and build better projections in the future. And when you see the evolvement happening on the climate models, it means that a lot of companies like myself, who are building these data sets, can apply the same technology as well, and then unlock additional insights for our clients to make better decisions in the long term. So it's moving really fast. I think a good analogy I like to use, it's almost like F1, the pace of innovation is moving really quickly. Every company that's out there trying to solve this global problem is coming up with new solutions that are really innovative, and we're kind of collaborating on this front, because in the end, I think everybody benefits if we're able to curb this.
I mean, to be fair to the business, I mean, I don't think it's probably more than 20 years old, if that. And if you think about, I mean, the investment business has been around since before the South Sea bubble 3 or 4 centuries ago, and we've got this thing that's coming up the rails very rapidly. And now we've got nature risk, which is another conversation for another day, that's coming along too. If you were projecting 10 years' time, when I will be retired, Chris will probably be retired, Alex and Samantha will be in the peak of their careers at that particular point in their lives. It'll be a very, very, very different business again from what it is today, I think. And on those incredibly wise words, I think we should probably call it a day before I start doing my long-term projections any more than that. One last thing. We are at IFI Global, or SII, Sustainable Investment Intelligence. We are doing a consultation on bringing in potentially some kind of ratings for climate risk and potentially nature risk. If you'd like to be involved in that, do let us know. We are going to wrap up that consultation in the next few weeks, but do get in touch with Samantha or me if that's something you'd like to contribute to. And I'd like to finish by thanking ClimateX very much indeed for suggesting this topic and being on this webcast today. And thanks to Chris and Samantha as well for their contributions to what is actually a very technical specialist subject, even within the world of climate risk. But well done, everyone who's followed this, and hopefully see you again the next time. Have a good morning, afternoon, or evening, no matter where you are in the world. Bye-bye, everybody. See you the next time. Bye.
Thanks, everyone.